today is intended to have that deep diving conversation about mortgages, everything there is, all the acronyms, as much as we can fit into an hour-long conversation. I would imagine an hour long is just the tip of the iceberg, but nonetheless, here we are. Phil, do you want to make a quick statement, and then I'll give it over to Kristen for a quick statement, and then we'll start.
Sure. Yeah, this was the brainchild of Kristen and I during Brian's meeting on previous Tuesday. And the idea was to open it up to, again, a more elaborate, deeper conversation than we normally do at sales meetings, because we're limited to a couple of minutes. So it ends up being a soundbite, and you may not actually get all of the nuance that you're looking for. There are a lot of newer faces on here, but there are also a lot of veterans and people like Gina Barrera, who actually have inside knowledge of the mortgage industry. So she's going to be my ringer, I think, for some of the tough questions. But don't be intimidated if you're new. Ask dumb questions, because there's really no such thing as a dumb question in our world. And if you have, something that is super geeky or analytical and you just want to ask it, please do that. This is the test that Kristen and I are looking forward to. So see if you could stump us. We'll try it.
Anybody, maybe Kristen Otto would remember the TV show on ESPN called Stump the Schwab, where they had this geeky guy who knew everything about sports and every sport, and they would try to stump him and you could win prizes. The prizes are to be determined. I don't know what Phil and Kristen are going to give up yet out of their own pocket, but there will be prizes if you could stump the Schwab, or Schwabs plural. Kristen, any
Sure. Yeah. Thank you for having me. I know there's a lot of Niskayuna folks on here, so I just wanted to introduce myself. I work alongside with Phil in the Clifton Park South office at Homestead. We're pretty much veterans at this point. I think we're both on our 14th year, Phil, here at Homestead. Yeah. So, our pins are stacking up in our office for our good service over here. But I brought the underwriting books in case someone was able to stump us. And I think Phil and I just wanted to, try and help you guys with things that are, anything that we don't really realize or see that we can help you guys with, with you guys being on like the front line of all of the transactions. There's just things that we don't, necessarily come across, or, we kind of fix it or, try to alleviate that from you guys. So, we're here to pick our brains and see what we can, help provide some knowledge. And again, thanks for doing this with us. So
awesome. And this will be recorded. Again, it will be uploaded to YouTube. If you don't want to have your face, or at least the little square box of your face on YouTube, just put a cloth in front of it, or turn your camera off or whatever, or do what Kristen's doing. So I did get a bunch of emails. Some of them are softball questions. Some of them are going to be more difficult questions. So I'm going to go through some of the questions that were emailed. We're going to have a conversation. Please, by all means, if you have a question, interrupt me, interrupt Kristen, interrupt Phil, and just ask the question. If you're too nervous for whatever reason, ask the question. Send me a message privately on Zoom or text me, and I'll ask the question for you. So first things first, how long do I have to pay PMI, and what is PMI?
You want me to start, Kristen?
Yeah, yep, you can go, Phil.
All right. Also, by the way, we'll be looking at chat. So if it's easier for you just to type a question in, feel free, and we'll hit it on the next go around. PMI stands for Private Mortgage Insurance. It is an insurance policy that's done on all conventional mortgages. The idea of PMI is it's kind of the bitter pill that you have to swallow. It is a necessary evil to do a loan with less than 20% down. So back in the old days, there was no such thing as PMI, and conventional financing required a 20% down payment. If you wanted to put less down, you went to something like an FHA mortgage. Now, the PMI industry kind of came about as a risk mitigator, and its whole purpose is to say to a lender, we'll insure this mortgage for you and allow your customer to put less than 20% down, and the buyer has to pay that as a monthly premium in their monthly payment. The PMI is very inexpensive right now. If you have very good credit and you're putting a decent amount down, 5-10% down, PMI is really not a lot of money. It's kind of hard for me to quote numbers here because, we're not talking about real scenarios, but it could be $40 for an average transaction, just to throw out an example. The buyer's going to pay that until they reach 22% equity in the property. So that will take them a number of years, but eventually the PMI will go away. So one of the big differences between PMI for conventional and FHA is the mortgage insurance for FHA never actually disappears. It does decrease over time, but it makes the loan more expensive. So we try to position our customers into a conventional mortgage if we can, because it's cheaper for them.
And does it automatically go away, or do I have to call the lending institution and say, hey, listen, I'm under that 22%, or I paid 22% down?
Kristen, you want to handle that one?
Sure. Yeah, at 22%, it actually falls off naturally. If you get to 20% equity, you can actually make a phone call and they have to, by law, take it off, but they're going to try and, I guess, get a couple more dollars out of you. There's also a way that if you do feel like your house has appreciated in value, I just had a couple friends down the street, knowing this current market, they made a phone call and, paid their servicer $400 to get an appraisal, and they were able to get that off faster than if it were to naturally fall off. One thing I did want to add, if you do an FHA mortgage and you put 10% down, it will fall off as well. So, but typically FHA borrowers don't have the funds to do that. So
is FHA PMI more expensive than conventional? Stanley Carwin.
That's a loaded question. It's a good question. If we assume excellent credit for somebody, the FHA will be more expensive monthly. But there are situations where we have to put a customer into a conventional mortgage. For one reason or another, FHA won't work. And if the customer's credit score is not great, the conventional can actually be more expensive. So yes and no.
Yep.
Spoken like a true, I don't know. I think George on this call, maybe a true lawyer. I don't know. George, you here? What's the difference between... Well, listen, I don't want to give you the floor because I don't want you to have a 37-hour story. All right. Between you and Phil, we need to tighten this up. What's the difference between PMI and MIP? And what do those acronyms mean? I mean, we talked about PMI, but, we take for granted a lot of times. And, I had this conversation with you, Phil, actually, about my tax advisor using all these different acronyms and forms and things. Like, I'm supposed to know what that means. The average consumer is not going to know what MIP means. So, Kristen, if you're talking to your clients about MIP, you might want to break that down. Not that you've ever done that, but I'm just calling you out since you were typing. So anyway, Phil or Kristen, either Kristen.
They're technically, the MIP stands for mortgage insurance premium and PMI is private mortgage insurance. So the concept is basically the same. They're both doing the same thing. The MIP is actually part of a FHA loan. So, typical, it's definitely similar, clause there for that. They basically are protecting the bank from someone, either credit wise or not having the 20% down payment, that if they were to walk away, the bank would still be getting paid. So yeah, Phil, I don't know if you want to add to that.
You nailed it.
Okay.
Awesome. You get circle gets the square. So we're kind of just running through the questions that were already pre-asked, and then we're going to have more or less a dialogue and a conversation. Is USDA or VA a better loan? They're both 0% down? Question mark.
That's a question I get often, but it was actually asked recently, so I threw it over to you as a good question. I told the person I would answer on here. So USDA and VA are both very similar. They're both 0% down. But what I'll tell you is in most cases, the VA loan product is probably the best program going. There are some really weird quirks to the program that can make it a little more challenging, to just get the processing of the loan done. But from a financial perspective, you pretty much can't beat VA. So here's the feature: 0% down and no monthly mortgage insurance. with low closing costs. For us at Homestead, our closing costs are lower on the VA than they are any of the other programs. So you get all those features with low interest rate. There is an upfront fee that gets rolled into the loan. For most veterans, some can be exempt for certain reasons, but the VA program is pretty much better than, if you're putting the least amount of money down, it's going to beat FHA or conventional any day of the week. So just because they're both 0% down, there are some nuances that make that VA product just outstanding.
And obviously, VA loan, you have to be a veteran to qualify for a VA loan.
You do, and well-deserved if you are.
Yes,
Yeah.
100%.
It's definitely like a thank you for their service. You know, the rates are extremely low, and you know, the lenders typically chip in on reduced cost, and you know, it's just there's no monthly mortgage insurance, so it's really a thank you.
Okay. And real quick, I mean, can you break down what a USDA loan is? I know that we have a bunch of folks on here who are brand new. Some of them haven't even taken the course yet. So I don't want to take it for granted that everybody understands what a USDA loan is. Has nothing to do with the Food and Drug Administration. Well, to a certain degree, right? It's not like a food where they're going to put their package on it. So, you know, Phil, Kristen, can you just elaborate on what that is?
Sure. Yeah. It's basically it's the farmers. It used to be the old farmers home loan. So what that means is it's for more of a rural area. So each time someone finds a home that they, you know, potentially want to put an offer in, Phil and myself have to go to the USDA website and confirm that it's not, or that it is in a rural area and it's USDA approved. You know, you can type that in on the map. We can send you guys the link. It's, you know, extremely user friendly. You also have to make below a certain income level according to each county. So that's another thing. It takes into effect, you know, how many people are in the household, and, you know, the income. It takes the total household income. So even say a spouse or, you know, a domestic partner is not going to be on the mortgage, we still have to get the entire household income, and it can't go over that threshold. So each county's got, you know, a different, we have all the tools to let you know what that income level, you know, limit is, and if the house qualifies on the maps.
Awesome. I'm going to do a quick screen share. The USDA, all you have to do is Google USDA Eligibility Map or use the link that Phil sent. But just for fun, I typed in an address of my new listing right here, and it says the address is located in an eligible area. It's that simple. Do your homework prior to. If you have something that's on the cusp, and maybe your client doesn't even know that USDA is an option. Maybe they're not using Phil or Kristen, and nobody's talking about the different products and programs out there. This will be a way for you to differentiate yourself as an agent by saying, hold up, we're looking at Schoharie County. We might be USDA eligible. Let's talk to Phil. Let's talk to Kristen. Let's talk to your lender, and let's see what we can do. And let's see if we can give you a chance to have, you know, no money down, things like that. And also be careful with using that term, no money down, because again, there is still out-of-pocket expenses. You know, sometimes people hear no money down and they think, oh, I'm just going to go to the closing table and get keys with nothing. So you do have to put your earnest money deposit down. You do have your out-of-pocket expenses, you know, the regular inspections and everything along those lines. So thanks for that bit of knowledge. If everybody wants, Phil put that link there. You should copy and paste it. Save it as favorites in your browser. Put it there. Keep it peace of mind, top of mind. And also, if you forget the link, just type in US eligibility or USDA eligibility map on Google, and it'll pop right up. This is a question that we had, and Phil and Kristen are going to probably hate me for this question, but this is making people awkward at best. And this is a question that we get often as realtors. And so here it is, Phil, Kristen. In multiple offers and representing the buyers, if Kristen and Phil feel it's helpful for them to call the listing agent to assure them the buyer is well qualified. I know this is very similar to the letter, right? We talked about the letter and the nuance to the letter and being careful. And, you know, Phil, from a legal standpoint, I'm sure there's certain things you can and can't do, right? You're handcuffed, right, Kristen? So I'll let you guys take that. And if you all of a sudden have technical issues and hang up, I understand.
All right. I just put a link to something called the Graham-Leach-Bliley Act. It's boring. But what it basically means is that we have a due diligence to keep our customers' personal, non-public information private. So the problem is that any information that the seller can or the listing agent can glean from a conversation with Kristen and I can be used against us. There's nothing in a listing agent's best interest to help better the buyer situation, right? Where you're in a negotiation is called a negotiation for a reason. Everyone's looking for a piece of leverage. So will if a listing agent calls me, will I hang up on them? Absolutely not. That'd be stupid, rude, and would be detrimental to my career. But I have to be very careful with what I share. So if they say, can you tell me how well qualified that buyer is? It's a loaded question. And how do I answer that any way better than what my pre-qualification letter says? Now, one thing I'll tell you is that not all pre-qualification letters are written the same. Some banks will just say, your buyer's qualified, excuse me, for a $200,000 conventional mortgage with no context. That doesn't mean anything in the real world. But if you read Homestead Funding's letters, which I guarantee none of you have because no one reads all of the verbiage, I barely do, it does actually say a lot of information. It says I've reviewed income, work history, assets, credit, an in-file tri-merge credit report. That means I looked at their entire profile the same as an underwriter would. And I've made an evaluation with 15 years of experience. So what the listing agent doesn't know is that I'm not new. I didn't just talk to the person on the phone. I actually reviewed financials. And that's the information that I help relay to them to kind of assure them. When they try to ask leading questions that delves into more of their situation, I have to find a polite way of just saying, we're kind of delving into non-public information that I can't share. So I think sometimes just that nice warm touch, that conversation to make sure that I'm not a serial killer is helpful.
To be determined.
But yeah, there's no more context than I can glean in the conversation than what's in the letter.
Well, and I know from firsthand experience too, we had a transaction not too long ago where the listing agent was adamant about talking to you. And
she was pushy too.
Pushy, like super pushy, saying, "Oh well, every mortgage originator talks to me." Well, every mortgage originator is in fault for doing that. But I do remember when you had the conversation, you basically told her exactly what you told everybody here, that with my 15 years experience, I feel comfortable, moving forward. I reviewed all the documents. That there's nothing more that has to be said. I'm not going to do a pre-approval on somebody who, why would I waste my time, your time, the realtor's time, the buyer's time, the seller's time? And I think sometimes just that matter-of-fact conversation, I mean, it helped the listing agent feel at ease to a certain degree, right? Sure. And I think that goes a long way, all while keeping the confidential information confidential. Kristen, I know that Phil landed it and nailed that one, but do you have anything you want to add?
I kind of think the same thing. My technique that I use is I basically confirm exactly what is on my letter. So I said, yeah, this is, 123 Main Street. Yep. And the taxes are 5,500. Yep. Okay. Yep. I've run that. So yeah, you have my pre-qualification letter. Does it say, what are you looking for, any additional information to be added to that, price or address or whatever it may be? And typically it goes well. You're just literally rehashing what your letter already states. So nothing more than what's out there. And I always say I don't put my name on something if I don't feel good about it. So
awesome. I think the one thing that always makes everyone feel more comfortable is I explain that I don't get paid unless that loan closes, just like you don't get paid unless that house closes. And it tells a listing agent that we're all pulling in the same direction.
Yeah.
It's mutually exclusive. We all want the same thing. What I am going to do is I am going to randomly call on people throughout this conversation to have them ask a question. So if you don't have any questions at the top of your head, I will have you Google them so that way you're not completely blindsided. But as we continue on, what is the difference between a second home and an investment property?
Is that me, Phil?
You can
Yeah,
take that one.
okay. Yeah, no, I got this. I got this. Okay, so a second home is typically where, where they're not primarily residing and not where they work. So, people who live in the Capital District, they have second homes, Lake George, Lake Placid, Saranac Lake, Florida, wherever it may be. And they're not deriving any rental income from that property. So it's not their primary residence where they live, where they work, and it's not, where they're filing their tax returns if it's in a different state. And an investment property is a home that is owned, for rental income. Could be single family, it could be all the way up to 4 units, and that is a residential investment property where they are collecting rental income and not residing.
And how do the rates differ between the two? I mean, is the second home more, is it more scary for the lender, or is an investment property more scary? I'd imagine the investment property is probably the scariest one, but
I would say in terms of risk, an investment property is considered, has layered risk on it. A second home is actually technically in the primary residence category. It's just somewhere that you could reside for a portion of the year. The investment properties, obviously dating back to the mortgage crisis, that was the first thing that people walked away from because it wasn't where they physically lived. So, things have tightened up, but, investment properties are awesome and, people qualify. And I would say the rates, it all depends on credit and down payment. So, they're obviously a little bit higher, but the second homes are treated as like a primary residence interest rate.
Yeah, funny you bring that up. I had a flashback to 2006, 2007 when I was working at First Guarantee Mortgage with this guy who will remain nameless, and then Guardian Loan Company. So I really hit the trifecta. And we would always remember ICE, income, credit, and equity, and that's what really drives your interest rate, things like that. Flashbacks, and then the crash happened. So I guess we're not going to be doing any more no income, no asset loans anytime soon.
No,
those are a thing of the past.
No, they're actually after the mortgage crisis in 2008, there was the Dodd-Frank Reform Act, which basically just created a bunch of safeguards and rules for the mortgage industry because it was more or less the Wild West before that. They left it up to kind of the industry itself to figure out its risk tolerance. Those loans legally really can't exist unless there's some type of hard money lending.
And for those that don't know, when Phil says the Wild West, it literally was the wild. We weren't licensed in New York for obvious reasons. I don't think that the owner wanted to have anybody find him and track him down. But we would have waitresses, tellers at Walmart, gas station clerks saying, okay, well, I want to buy this house. How much money do you make? Nope. Show me you make more. Just write down a piece of paper. How much? 140,000? Sure. That's what you make overtime. So it was literally the Wild West. And, for them to put restrictions and to kind of govern it is absolutely amazing. It might seem like a pain in the butt now to go through all these loops, but it is absolutely protecting the consumer, which is what it's intended for. Can you finance a mixed use property?
You can. So as many of you may or may not be aware, I have a little bit of a specialty niche, which is renovation mortgages. So the interesting thing is that there are 2 different worlds of financing. You have residential and then commercial. Normally, anything that is mixed use or has any form of commercial nature to it has to go commercial financing. And it's completely different than what Kristen and I do. So for everything that we've discussed today and everything we'll almost always discuss, we'll be talking about residential financing. And in our world, again, if it has a commercial entity, you usually can't touch it. But there's one loophole, and it's with an FHA 203K mortgage. So I actually, Kristen, I may be one of maybe a dozen transactions Homestead has ever closed that's been mixed use, but I'm talking 10 years ago. I helped a gentleman buy a 3-unit property in Troy that had some type of low traffic commercial entity on the first floor. It had the second floor was residential and the third floor was residential. And this thing was immaculate. I mean, at the inside, I still remember in my head, it looked like, you know, when you see like all these good looking people in a Heineken ad and they're all partying and it's like cool and everything's like stainless steel and brick. Yeah, that was this guy's place. Like I want to live there. It was an amazing, awesome, like bachelor pad. But we had to put him into a renovation loan, and there was really nothing that needed to be renovated. The house was perfect, but he understood that it was cheaper to go with that mortgage than do commercial. So the way it works is that the commercial part has to be a minority percentage of the square footage. So in this case, it was perfect because it was a 3-unit. 1 unit was commercial. The other 2 units were residential. It was predominantly residential. But if you have a 2-unit, it gets dicey, because if the commercial entity is like 55 or 60% of the square footage, and the other is 40 to 45%, that's residential, you can't do it. So it has to be majority residential. There are ways we can, you know, kind of be a little creative with, like, the stairs could be part of the residential unit instead of the commercial if it's like 51% versus 49. But for all intents and purposes, you have to be looking at something that's low traffic when it comes to the commercial part, and it has to be predominantly residential in nature. And it'll work with an FHA 203K. So for him, we did like $5,000 worth of just miscellaneous upgrades to the property, and he's happy.
Awesome. And I know you mentioned 203K a few times. Can you give in layman's terms like what that is? I know that you've talked about it a few times at our sales meeting, where you don't just buy the house and then afterwards you get estimates from a contractor, like getting all of your ducks in a row. If you could just kind of talk on that and give everybody the heads up of what that means and the best way of facilitating that.
So a 203K is one type of what's called renovation mortgage. We also do another one too. It wouldn't work for mixed use properties, but there's a conventional alternative called a home style. And what the 203K and the home style are they allow a buyer to buy a property that can either be in a state of disrepair. So it's normally like something you'd look at and say, this is a cash deal. Like you can't finance this. Or it could be something where the property is fine, but they just want to add their own touch to it. They want to improve it and make it better than what it currently is. They buy the property for its price, and they take contractor estimates up front. We need that like before I can even send the loan application to the buyer, and we combine them together. So for example, they buy a $150,000 house, and they could put $50,000 of work into it. I mean, they could put $150,000 of work into it potentially, but say take this 150 home and put $50,000 worth of work, and we make everything based on 200. It's just one mortgage. It's not 2 separate loans, and they're cool. It's a great mortgage.
And how do those funds get dispersed? Is it, you get the 150,000 to buy the home, it's yours, and then do they give you a blank check for 50,000, or do you have to do that in increments, kind of like, when you're buying new construction, where every now and again you give them a little bit more and they do more work?
Yeah, it's done as a reimbursement. So depending on the project and the cost for the project, we may have anywhere between 2 to 5 draws. So for something that's, let's say, $100,000 build, we may break it up into 5 different draws, and they're not formal draw schedules. They're basically just reimbursement checks. So the contractor gets about $20,000 into the project, and we'll send an inspector out, make sure the work has been completed, cut a check payable to the contractor so they get reimbursed for their work. And we'll keep doing that along the way. So they're not out $100,000, for the 6-month project. We'll make it easier on the contractor.
So very similar to a line of credit, but instead of the owner pulling the money out, the money gets dispersed in a check directly to the contractor. And that's why it's very important to have the contractor, all of the estimates, have everything up front. So that way, what you're getting involved with. There's nothing worse than, let's say, working on a house in Lake George for 3 years and not having any idea what your final bill is going to be because, your contractor just, willy-nilly goes up there what he feels like. But I digress.
That would be awful.
We do confirm the work's complete too. So it's a little bit of a safeguard too, Ryan.
Yeah, well, I'll show you my bathroom. It is far from complete.
Hey, Loretta, did you have a question? I saw you unmuted yourself.
Yep, I did. For the 203K, if there was a house that says cash offer only, is that what the buyer could use? Or does that mean cash, really cash?
Well, cash offer may indicate that they just don't want to deal with the hassle of a mortgage to begin with. So I would always obviously, throw a query out to the listing agent and just say, hey, I have a renovation opportunity here for a buyer. Would you consider financing if they do a renovation mortgage? In most cases, I would say, yeah, because, cash is king, right? If you come with a good offer, they're probably going to take it. The only downside with the renovation mortgages is they take a little longer. I consider myself kind of an expert, and I'm still looking at 60 to 75 days for a normal transaction. It's not a 30 to 45 day deal like we can normally do. There's a lot more involved. There's just more chefs in the kitchen. It's a lengthy
And you have
process.
to get those estimates done ahead of time, obviously.
You do. So the thing that gets tricky in this market, because everything's moving so fast, is normally I tell my buyers, go to the property, do your second showing. Most buyers go through once, they love it. Then they want to bring their uncle and their cousin and their mailman and everybody into the property the second time. But I tell them, when you're bringing your entire family tree, bring a contractor, because that's the person who's going to tell you your numbers. The key with that is that they'll know exactly what they're dealing with. They come back to me and they make sure, buyers are like, this kitchen, bathroom, and, master bedroom remodel is going to cost 15 grand. Okay. So when they come back with $100,000 estimate, it may shift their perspective and they may decide not to buy the property. The real key is this. Once you make that offer and the offer is accepted, the clock's ticking, right? Because the way we write deals here is it's not like downstate where you write a binder, the attorneys write the contracts. There's a date locked into that contract, and then attorney approval happens within a day or two. So that the challenge is we have this artificial date put on the contract. Well, if we're waiting on a contractor to provide estimates, that's a problem, because Kristen and I can't send a loan application out for a renovation loan unless we have those contractor estimates, because all of our numbers are based on not just the purchase price, but the purchase price plus repairs. So right now it's a really tricky situation because of the market, but
so actually, if they want a cash offer, this 203K would actually even be worse for them because it's not as quick as cash.
Correct. Yeah. Mortgages are never as quick as cash. And then these take even a little longer than a traditional mortgage. So it's one thing to consider, but if you come with a good offer, that number is what matters.
Right. All right. Thanks.
You're welcome.
And a lot
So
of
I had a question too.
Yeah, knock yourself out.
With the renovation mortgage, is there like time restraints on it? Like the renovations have to be done at a certain time?
It's typically 6 months. I mean, right
6
now
months, right.
we'll allow some leniency because of COVID and, everything's upside down, but normally it's 6 months.
All right.
With the renovations to be made, is there like a limitation on how far you can go with those renovations? Are they just basic renovations, or could you, really improve the quality of the house? I guess, how do they determine, what is acceptable in putting that loan amount in?
Kristen, I know I'm taking a lot of your thunder here. But,
No, you're fine. You're doing great.
So the thing with the renovation mortgages is that they're designed to be capital improvements or to fix what we would call deferred maintenance items, peeling paint, utilities that no longer function, or broken windows, et cetera. As long as you're improving the overall value of the property, it's pretty much allowed. So it's typically A plus B equals C. A is the starting value of the property. You bought it for 150 grand. B is you put 50 grand into it. C would be 200,000. Generally, it works like that. It's as simple as that. There are no luxury items. You can't install pools, no hot tubs. Bummer. You can't buy that flat screen TV. It has to be permanent things for the property, because we're only financing real property, not personal items.
Could you put an addition on?
You can. I've done several additions. You absolutely can. Definitely.
So there is one, isn't there a percentage of the home's value, or has that gone away?
So with FHA, you can almost improve to whatever the after improved value will be, as long as the market can support it. You know, I make a joke all the time. You can't build the Taj Mahal in the middle of Schenectady. It's not going to appraise. But you can put it in Westchester and they'll find a way to make that value work. The thing with the conventional mortgages, there are some rules where there's a certain amount of renovations you can't exceed. It's very hard to hit that threshold unless you're buying like a $20,000 city-owned foreclosure. For something like that, we're almost always going FHA because sky's the limit almost on the after improved value.
And where do you find like that after improved value? Do we, as realtors, get comps and say, okay, this is for 150, this neighborhood can support 250, so we'll essentially have $100,000 worth of wiggle room? And what's to stop somebody from over?
That's why those estimates are like so crucial,
Well,
because we have to submit those to the appraiser.
Gotcha. So that would be important because the last thing you want to do is have somebody buy a house for 150. They put 50 into it in a neighborhood that is 130, right?
Yeah.
Then you're upside down. I mean, granted, you have granite countertop in your home, but you're still, you overvalued your property.
Correct. So. FHA has a really cool rule because FHA, you may or may not know, is a division of HUD, which is Housing and Urban Development. And HUD's mandate by law is to, one, create oversight for the mortgage industry and for all purchase transactions, even rentals in the US. But HUD's real mandate is to improve the overall living standards of home ownership in the United States. So the cool thing about the FHA 203K is that the house can underappraise by 10%. They'll still do it because it's a rising tide philosophy. Like, if you're in Hamilton Hill and someone does a renovation loan and they really improve their house, well, it helps improve the overall value and appeal of the neighborhood in general. So you can have this slight differential between what the market will support. And as long as it's not more than 10%, they'll still okay it.
So kind of like futures, just looking at the future and appreciation. And I know house in Hamilton Hill, believe it or not. I mean, I know Redway sold one for a ton of money, completely renovated. So, kudos to him and everybody else for increasing the neighborhood one property at a time. I know Barry, Griggs, and D'Onofrio do a fantastic job with the city-owned homes as well. And again, it's just one property at a time, slowly but surely increasing that value. I know Stanley Carwin, we're going to kind of veer off of the 203K. It seems to be the hot button today. If you have any other additional 203 questions or reno loan questions, Phil and Kristen will be here. But Stanley asks, is a pre-approval a soft pull on your credit? Can you assume that the actual approval will be lower than the pre-approval?
I could take that one, Phil, if you want. Give you a break.
About time we shut Phil up.
Well, there is a little thing that happens out in the world that if you're not a banker, you might not know the difference between a pre-approval and a pre-qualification. So a pre-approval is actually when somebody has gone through the official underwriting process, and that is a hard pull. Those words are interchangeable. Half the time people are saying pre-approval and our pre-qualification is okay. Our pre-qualification is just a soft credit pull. So the difference is the pre-approval, which this is actually one of those advantages that Phil and I talked about that Homestead offers, is what's called our Home Express program, where we're able to do a full file just like you were under contract for a house, and everything is just titled like 123 TBD, and we do everything and you get a full bank commitment letter. So that would be that's the real pre-approval. That is a hard pull, and you do have a full bank approved commitment letter. So in this competitive market, that's definitely a positive and has become, a much bigger advantage for people, because basically at the end, you just drop in the house, the appraisal, and, wrap things up nicely. So that's the difference. The pre-qualification, that's just very, nice and easy for a person. We do the soft pull. Some people that are maybe looking at new construction, credit pulls are valid for 4 months. So with the soft pull, that could expire before you're even under contract or something. So it makes it, basically your credit doesn't have to drop while you shop type thing. Especially in a market that, I got a guy who put in about 18 offers right now and he can't get a house. So, that's where he should approval process and doing the hard pull. But, in the meantime, his credit doesn't drop because they've only done soft credit pulls. So.
And just to kind of echo what you said that their pre-approval is good for 4 months? Or?
It in a normal world, it's valid for 120 days, the bank commitment. But right now, due to COVID, we are re-verifying pay stubs and bank statements under the 4-month mark. So
and then
that's just a COVID.
Okay. Yeah, and that seems to be a norm right now. Buyers are looking around for 4 to 6 months before they can even get something accepted. Which is unfortunate, but that's the time we're in. Kristen asks, "What's the deal with Sunny May?"
Well, actually, I have another quick question before we get to that, because I feel like that might be a little bit longer of an answer. Can we talk about rate lock for a second? And for example, like with everything being backed up, how is that affecting people's rate locks?
Kristen, you want to take that? I feel like it's on the shot clock before.
Sure. Yeah. No. And if you're referring to an existing home, I mean, we have all the way to an 85-day rate lock on an existing home. So, that's, we lock through the anticipated contract date. Phil and I definitely try to add a buffer at this point in time to that rate lock. If you're building, we offer a 9-month rate lock, and that one is actually the one I think that's suffering right now, is that the builders, even they think it's going to be done quicker than it's happening. And, just with delays of shipping and lumber and that kind of stuff. So with that being said, what we like to do, and I work with a lot of new construction, is that we try to get you approved and are pretty much floating you until you go to like your pre-construction meeting with your builder to get like as firm of a date, they're ordering permits and, you're moving forward at that point. So, we try not to jump the gun if we don't have to. But for the existing homes, we're fully functioning and, operating under proper times where the contract date is really the indicator to Phil and I on how long to lock for. And, we try to add a little bit of extra time on the end of that. So.
Cool. Thank you.
Rate locks are a double-edged sword, because the shorter the amount of time that we lock them, the more competitive that rate lock is. So we're always trying to find that balance between giving the buyer enough flexibility and time, just in case there's extra, stuff added to the end of the transaction, versus just arbitrarily giving them a rate that maybe is 0.1% higher. So it's always a balance, and it's a tough call, but we weigh the pros and cons and help the customer make the best decision for their needs.
And we definitely follow the market. I mean, we have a couple of services that our office particularly follows, and, we get alerts to lock. We know, all of us here, we all know what's happening with the economy. Literally, I just checked it while I was sitting here to see what's going on with rates. So
what rate can you get me?
I'll pull your whole profile for you. Okay.
For you, 1%.
Thanks, Phil. Appreciate it.
You're welcome.
I heard on the news, Phil, I heard you had 1%.
This is not going to be on YouTube, right?
No, I get 0.5%. All righty. So Chris also asked, what's the deal with Sunny May?
I don't mind fielding this one.
Thank you, Phil.
Sunny May it's an awesome program. So the thing with Sunny May is that it has its moments where it's great, and it has its moments where it's not so great. And for a long time, where we had very, very low interest rates, the historically low interest rates that we've all talked about last year, Sunny May is kind of a lagging indicator. It doesn't really become super popular until we're in this mode where we're in a raising rate environment. And when that happens, Sunny May tends to kind of fall behind that rate environment. We do a very quick screen share, because the cool thing with Sunny May is it's not like a big secret as to what their rates are. It's literally on their website. So if you Google Sunny Mae, you're going to find it on their site. And they have two different programs. They have their Achieve the Dream, which is for certain income brackets. And that interest rate right now is 2.625 with 0 points. And their low interest rate, which is designed for people that make a higher income, it could be, depending on the area, maybe 90 grand or so for household income, you're looking at a 3% rate. Now, those rates right now are much cheaper than probably the average you're going to find for a 30-year fixed today, being about 3.25. If you just, check with 15 lenders, you'd probably find it being around that mark for bullseye. So the cool thing with Sunny Mae is it's conventional financing. It's 3% down, and it's only in New York State. So it's relevant to everybody that is on this call. The thing about it too is that it's a great opportunity for, one, the low rate if the markets are higher like they are right now, and two, you want to think condos. Because if you've ever tried to do a condo purchase with an FHA or any type of government financing, you might as well just pull all your hair out, which is exactly what happened to me when I started. So I don't do condos and FHA anymore. I have no more hair to pull. The thing with Sunny Mae is it's conventional financing, which works much better with condos because the condo association doesn't have to approve it for FHA use. So I think condo, low down payment, we're talking first time home buyers here. So that's what it is. But someone with decent credit, you're probably a good candidate for Sunny Mae. You can even, I haven't ever done it, but I know of a colleague of mine who's done a Sunny Mae purchase with someone who had no credit score. And that's a problem normally. Someone comes to you with the need for a mortgage, but they're like, I pay everything in cash. I've heard that story a few times, and that's a problem in our world because if you don't have a credit score, we have no way to judge your credit worthiness. But Sunny Mae, actually, there's some loopholes, and it's going to be a process, but we can get that person into a house. So it has excellent features. It does have some quirks. It is underwritten through New York State. So you're going to add a little extra time to the clock. You're not closing this in 30 days. You're not closing it in 45. It's probably going to be over 60. But at the end of the day, if everyone's understanding about the timeline, cool product.
Awesome. That was very, very thorough, and I appreciate it. George, how do you do? George, you here? All right.
I think he's great. I think everyone's doing a terrific job.
Thanks, George. For those that don't know, George is attorney to the stars, one of my favorite attorneys to use and to work with. Just a great guy. Just want to give him a shout out, and we appreciate you being on here with us. So Alex, he's only real estate attorney. He's not criminal attorney, so just keep that in mind. Important acronyms to understand. We're going to go rapid fire. It's going to go Kristen, Phil, Kristen, Phil, Kristen, Phil. Super quick, 30 words or less. Ready, go. ARM, ARM.
Adjustable rate mortgage. Is that all?
Well, elaborate a tiny.
That was under 30.
I was scared. I didn't want to go fast enough. So that has the potential for your rate on your mortgage to adjust depending on what, there's a 3-1 ARM, a 5-1 ARM, 7-1 ARM, 10-1 ARM. So it's fixed for that allotted time, divided by 30 years of payments, and can adjust after.
And speaking of ARMs, they still do the 80/20s.
Not really.
Homestead does not offer that.
Okay.
Yeah.
And Phil, what is an 80/20?
Oh, it's a awesome mortgage. We call them piggyback mortgages. You had an 80% first and a 20% second, and there was no PMI needed, because that first mortgage was only 80%. So that customer was financing 100% financing with conventional loans. That was the Wild West. Doesn't exist anymore.
And yours truly currently has an 80/20, but I don't pay PMI, which is fantastic.
Did you get it at FGM?
What? No, I didn't get it over there. I got it when I was going through my divorce about 10 years ago. Had to refinance the house out of Aaron's name into my name, and that was the only loan available to me during my years of bouncing and trying to run a gym. So Anywho,
Won't talk about the pay option arm because everyone's head will explode. So
yeah, let's not talk about that. But I'm in a better place now, and thanks to Phil, he has helped me out with a few other mortgages that are not these weird, obscure 80-20. So thanks, Phil Reese. What is it, like the old Rogaine commercials? I'm not just a I'm not just on this commercial. I'm also a subscriber or whatever, right?
Yeah.
Did they have those?
Something. I'm a client. Who knows?
Something like that. Yeah. So thanks, Phil.
Close enough.
APR versus rate, Phil.
Obviously, I don't pay attention to the Rogaine commercial, but APR is different than interest rate. They're not the same. It's kind of that thing of pre-approval versus pre-qualification. They're actually different. So your interest rate is your rate. If the going rate today is 3.25%, when you include your closing costs and your PMI, that's APR. It summarizes your loan into one number. So you might have an interest rate of 3.25, but maybe your APR is 3.74 when you combine the other costs. It's sort of what I call a made up number. It's not a real tangible figure, but it does help summarize the loan to break it down for a consumer.
Similar to like an MSRP on a car and then like what you actually pay. And it's just weird numbers. We just want to know what our rate is and that's it.
One trick I always say with that is if you get your rate and your APR, it's a quick way to compare closing costs without doing a whole breakdown. So like one bank's rate and APR is less, there's less of a difference in between them and their closing costs are less.
Oh, look at that. That's a tip and trick that is worth its weight in gold today. So thanks, Kristen.
Yeah.
Now we're on to you, balloon.
Oh God. Okay. So when your kid has a birthday party, you go to the dollar store and get a balloon. No. Okay. So a balloon mortgage, actually, I know some people who had these. Typical, it's similar to the adjustable rate mortgage, but at the end of the allotted period of time that your rate was fixed for, so like a 7-1 arm, a 7-year balloon, your entire balance is now due to the lender. So you were fixed for 7 years at a rate divided by 30 years of payments, and then 7 years is up and you owe the entire balance. So the balloon.
Yeah, that does not sound too advantageous for anybody. Yeah.
I think they're mostly gone at this point too. Yeah.
Good. Aren't you all excited that you weren't involved with real estate and or the market back during the Wild West years? Buy down, Phil Reese.
Buy down is another phrase for paying points, but they actually do something good here. So if you have a rate and the prevailing rate with 0 points is 3.25%, you might be able to buy that rate down. And what you do is you pay a one-time fee and buy the interest rate to a different number. So for example, you might be able to buy the rate down from 3.25% to 3%, and that may cost you 1 point. So if your loan amount is $200,000, you're going to pay 1%. And that $2,000 fee buys the rate down by 0.25%. It's going to take some time to break even on that. But if someone's staying in a house for a long period of time, it totally makes sense. And if they have the cash.
And I mean, I don't want to put you on the spot with this one, but is there a certain timeline for break even, right? Is it, a good loan you would break even in 5 years versus, is there a time frame that you would advise the client, hey, listen, you're going to be there for 30 years, you might as well buy down the point, or, do you have any insight into that, I guess is my question.
I think it's relative to the customer's needs, but if it's a first-time home buyer, I'm not super keen on buy downs unless they're building that, beautiful house with that awesome builder, and they're probably going to land there for a while. But they're buying that $150,000, $200,000 starter home, and they have no kids, and it's 3-bedroom, and they're going to outgrow it when they start popping out those kids. And I really do honestly think that the buy down's not smart because it does take sometimes 5-6 years or so to break even on that investment. It's more for people landing in that house for quite a period of time so they can reap the reward of that buy down.
Yeah. I mean, if you're going to be in your forever home, be there for 30 years, then obviously it makes sense to pay that buy down off in 7 and you have 23 years left of savings, so to speak. Awesome.
And this rate environment, it's not like back when it was like 6, 7, maybe it made a little more sense, but with them so low, it's not, I don't typically recommend it either, but.
All right. And we have 2 minutes left, so we're going to zip through this. All right. DTI.
Debt to income ratio.
And what's the good percentage?
Preferably 44.9 on a conventional, but we can go up to a 49.99. On an FHA, preferably 49.99%, but we can get an exception up to a 54.99%.
So your debt can't exceed 49.99% of your income coming in.
Correct.
Perfect.
And that includes your house.
Okay.
Housing payment. Yep.
LTV.
That's loan to value. It's the opposite of down payment. In our world, we talk LTV. So if someone's putting 5% down, their loan to value is 95%.
And we're going to see who is paying attention. At what LTV does your PMI go away? We're going to see who is paying attention. Let's go, John Judsky. At what percent does the
22?
So LTV, so it'd be the difference, right? It'd be 78%.
88?
You'd be at 78. So we're going to give you a half point on that one, all right?
Partial credit.
Your head was in the right spot. You just, we're interchanging down payment.
Trick question.
Damn it!
I have to stump somebody today. You guys have been amazing. Pity, not what people feel. Never mind. Pity, PITI.
That is principal, interest, taxes, and insurance payment. So your full pity payment is your full housing expense.
And pity is when somebody escrows, correct?
Regardless, the underwriter has to approve you on your full pity payment. So everything to do that for your housing payment, we need to know about. So
awesome. And keep in mind when you folks look at, or clients look at Zillow and they say that your monthly payment is going to be X amount of dollars, that is just PI. That's principal interest mostly. Sometimes it's not even interest. Your taxes and insurance, and you have to think about it this way. Your principal and interest is financed over 360 payments, right? At 12 years or 30 years. Your taxes and insurance are financed over 12 months. So that will be one of the biggest portions of your monthly payment. So that's why a house with, $200,000 house with $4,000 in taxes might be, more expensive or less expensive than a $250,000 house with $8,000 in taxes, right? Because those taxes are going to eat up a majority of your monthly payment. VOE, Phil Reese.
One last thing too, if you don't have our app, get it. It's awesome. Our app will actually calculate the full PITI payment, including a PMI quote. So that's also included in the PITI. So if your customer wants, a more accurate payment calculator than the Zillow calculator, use the Homestead app. It's awesome. Check with your local LO and they will be glad to send you the link for it. VOE is verification of employment. We are required to do this upfront, a written verification to make sure that the customer didn't just fraudulently make pay stubs and W-2s. We check with the employer to make sure they work there. That's an industry requirement. And we have to do a verbal VOE. So if you ever hear at the end of a transaction that, hey, what's the status update? I understand our buyer gave you the last documents to clear them to close. And we say, yeah, we're just waiting on that verbal VOE. Now you're smart and you know what the VOE stands for. We have to verify with a phone verification that the employee still works there. That's very important in this COVID environment because, things happen. Especially last year was very dicey. I've had a few clients lose their jobs at the 11th hour and wasn't always pretty. So a VOE is verification of employment.
And it's also a way to squeeze out some extra overtime income if you're in a qualification issue. So.
Awesome. And last question, and I promise this to be the last one. And I remember these commercials when I was watching Matlock or Murder, She Wrote with my grandmother, and they would be pitching reverse mortgages. Yeah. Well, here's the thing. These were all questions and acronyms that we had preset.
Sure.
I wanted my job to stump you. So
we can talk about them. So
quick, what a reverse mortgage is, what are the benefits, what are the non-benefits, and what are the problems?
Okay, so a reverse mortgage actually pays you monthly instead of you making monthly payments. it's paying you monthly out of the equity that you have in your home. It's for older citizens.
63 and older.
Yep. We actually don't offer it anymore, correct, Phil?
Homestead no longer does reverse mortgages. They became a target because of, I think, abuse. That age bracket is considered a protected class for good reason. And lenders have to be very careful about the way that they do them. And we're just very concerned about any additional oversight. We would tend to do things by the book and do them the right way, and it just not open ourselves up to any additional liability. I think a reverse mortgage can be valuable under certain circumstances. Somebody who needs to retain their house, that's where they're going to live. They had a death in the family. They have a lot of equity in the property, and they want to convert that equity into some form of payment schedule so they can still live in the house. That may be a great way to do it, but they do come, in my personal opinion, at a very high cost. So they should always weigh other factors before making that final decision.
Yeah. It's like a monthly, Social Security check or a monthly, distribution. So, if it's kind of, like the last resort if it's needed.
Okay. Awesome. Well, I appreciate your insight. Does anybody have any final and or additional thoughts, questions, comments, concerns before we wrap this up?
I have a quick question.
Of course.
If you're in a FHA loan on like a multifamily, like 2 or 3 family house, and say 3 to 4 years down the road, you want to invest and you have money and you save money to invest into like another income property. Now, say you move out of that, say, apartment building or multifamily house, and, because like you can't get an FH for an income. So if they move out and now they're renting, say, 3 units and they don't live in the house, is that going to affect the terms of the loan?
No.
Okay.
FHA says you have to occupy within 60 days. That's a wormhole we're not going to get down right now. But you do have to live in the house for a year. Anything
okay.
after a year, you can convert it to a rental, and it's perfectly legal. It's not even a gray area. They're absolutely okay with that. More likely than not, you'll be doing conventional financing on the next deal because you have an existing FHA, but you don't have to change that mortgage. You can keep it the way it is.
Okay.
Awesome.
Thank you.
Great
Good
question.
Yeah.
It is.
I think Stan wins the question of the day award.
Thanks,
Stan. All right. Well, again, thank you, Kristen. Thank you, Phil. We appreciate your time. As always, they are here 24/7 for us. Call Phil late at night. He's here to help. Call Kristen early in the morning. She's an early morning person. So with that being said, I hope everybody has a great day, and I will chat with you all soon.
Bye, everybody.
Thank you very much, everybody.
Bye.